Hello and welcome to Weekend Investing Daily Bytes. We are shooting episode 241, 6th of June 2022, and oil isn't fading away. I mean, despite all expectations that oil prices would drop uh, after the Fed has started to tighten, that has not happened yet, and in fact, there are more forecasts for higher oil price. So we'll look at the charts again on oil after the market update. So market opened, uh, I would say, slightly gap down, but pretty much remained sideways during the entire day. Of course, Nifty did make a comeback and closed only 0.09% lower. Metals were also bouncing after the drubbing that they've got, despite the news that further softening of prices is likely to happen shortly in the domestic market. So pretty much across the board, there was a lethargic movement, a weakness, uh, not really showing any kind of strength in any pocket. And I think the market may also be now waiting for the RBI meet, which is due this week, for expecting another rate hike. It is largely expected that another 0.4 or 0.5% may come around, and maybe it's just wishful thinking so far that that may not happen. So if that comes around, maybe there will be another a bit of a shock to the market despite expectations, and that may take us back again to 16,000 or below that. But let's see how that works out. In the last 1 week, 5 sessions, market overall has not moved much, within 2% plus or minus on most sectors. In the larger scheme of things, small caps and mid caps were more hit today, 0.6% and 0.3% down, whereas large caps were pretty much flat. In terms of weekend investing performances, MIATH2 was the top gainer, plus 1.8%. MIATH2 has done well in the last month or so. I think it has beaten most other strategies, but of course, from the top, it has still a long way to go to recover. MI25, a sort of a always performing strategy, I say, because I've seen this now running live almost 6 years, more than 6 years actually, 2016 till now, 6 years and first quarter. It's always beaten my expectations. So MI25 is a real nice strategy. MI50 as well. Other strategies were flat, and MI Evergreen was down 0.8%. Not much of change in all other strategies, but ATH2, of course, was shining through the day to day. In terms of the top gainers, Oil India up 11%. I mean, I think this hit some 6 or 7 year high uh, in today's session. Other gainers were Hemisphere, Ratnamani Metals up 8%, Thyrocare and Glenmark Life 5.5%. Most pathology lab stocks were going up today as numbers are going up for COVID. I think Maharashtra is seeing some larger numbers. So again, the same story to some extent is repeating again. Suzlon was a major loser on the losing list, minus almost 10%. VMart down 6%. India Bull Housing down 5%. So India Bull Housing has really taken a beating from even very recent levels, more than 60 or 70% down. Amber Enterprise is also, I think, about more than halved, is now at 2600 or nearby, down 5% today. And Ratan India also down another circuit, minus 5%. It was hitting upper circuits in the last week, and now it is hitting some lower circuits. Oil India, as we were talking about, so is at 278.9. It's hit a new high since 2015, so about a 7 year high on Oil India, and it has potential to go up further. It has support near 220 odd levels, and it has broken out of this consolidation in sort of a cup and handle formation, and also taken out these these key resistance levels. So looking very good. RSI is still not too high. Oil and oil related stocks are all doing quite well. This is the Brent USD price. It's hovering around $120 per barrel. Citibank analysts have raised the second quarter Brent crude price forecast by $14. So average second quarter price is likely to be 113, which was below 100, and I think this price is going to move up. So we are on oil, on Brent also very close to 10-year highs, and on a monthly basis probably we'll get close to 14-15 years high, above 122, 123. So all this does not really augur very well for our markets. Our markets are very, very sensitive to oil prices, as we are major importer of oil, and while we have increased our imports from Russia, which is offering us cheaper oil, predominantly our oil is non-Russian, and that hurts us when the oil prices go up. So I think from a economy perspective, this is a very major headwind that exists, and you can't really wish it away. The war in Ukraine is also nowhere close to any conclusion. The sanctions that have been put on Russia are also not being withdrawn. So there is going to be more and more pressure on oil and gas, and essentially if you wish to look at strong momentum sectors, it will have to be oil related sectors which are showing fantastic strength in the market. Another sort of worrying sign was posted by Macro Compass. This is one blog that I follow, and it was there on Twitter as well. I'm forgetting who posted this, but what they're measuring here is credit impulse. So credit impulse is a term which was coined by Michael Biggs, an economist at Deutsche Bank, in 2008, and it is defined as the change in new credit issued as percentage of GDP. So this blue line is the credit impulse, and you can see that this blue line was positive during 13-14, and then it kind of went into a slowdown in 14-15, again up 15-16. So it is very cyclical in nature, and very recently from 19 and after COVID, there was a huge impulse up. So 4 to 5% of GDP was the new credit issued, and that creates a lagged impact on the earnings, as shown by this mustard line, where the S&P year-on-year earnings increase. So while this was coming down here, you could see that there was a lag impact a year later. But in terms of bottoming, the credit impulse sort of plateaued here, positive plus 2.5-3%, and S&P earnings were delayed by a year and a half here. Then again it bottomed here at minus 1%, and S&P earnings bottomed here in December 2020, and now the credit impulse has gone dramatically low at minus 4.5%, lowest in the last decade, and the S&P year-on-year earnings growth, if it comes with a lag, then we are looking at something coming down to this point at minus even 20%. As per this chart. So model implies that the earnings will follow, whereas the analyst expectations are currently at plus 9%. Model is implying minus 10 or minus 12 or 13%. So a bit worrisome from this model perspective. However, if the slowdown is coming and it is identified ahead, maybe Fed will sort of stop to tighten, maybe some QE can return. Maybe there is some other uh, impulse that is provided by the governments to counter this. I don't know what is going to happen, but uh, this particular model seems to be predicting a real slowdown coming forth. So we can only hope that this is not true, and there is some corrective measures that can be taken uh, while we are waiting for this fall. And maybe Indian markets will behave very differently from the US markets, in this sense that even if we are growing at 6-7%, 7.5%, we may still attract uh, capital in case the rest of the world is going down and we are the only ones sort of standing in positive territory. That also may be a positive, but it's very difficult to say how things will pan out. And right now, due to oil and due to these kind of prognosis, things look a bit bleak. That is for sure. So this is all I had for the daily bite today. Please do keep watching this channel for similar daily thoughts and insights into the market. Please do share this with your friends and family, and do give us feedback on how you like this particular channel. Thank you so much. Goodbye.